Hello everyone, am I audible today? Can somebody give me a heads up? Yes, thank you so much. Okay, so what we are going to do is we are going to start our session in next couple of minutes because we'll wait for another couple of minutes for people to come in. Now, before we start, can somebody quickly write in the chat what did we do yesterday, what exactly happened, or what are we expecting to do today? Or did anyone look at something what we did yesterday? Did somebody tried something for a different company? So Path did company analysis. What kind of company did you look in, Parth? And what kind of analysis did you do? Or you just looked at the financial statements the way we looked at it yesterday? Was only Parth who did something, or anybody else also tried to do something? So you didn't practice it. Anybody did anything? I did analysis of Reliance. That's nice. Anybody else? So you have looked at financial statements. Anybody can tell me what are we trying to look at today? Ratios. I had done TCS. Not bad, not bad. So we are trying to look at ratios today. Does it seem like a natural next step to look at the ratios now after doing financial statement analysis? Does it seem like a natural step that once we have looked at the financial statements that we are comfortable with whatever that company is doing, so that now we are okay to look at the ratios to understand what it is trying to say, what the numbers are trying to say? Everyone agrees with that? Okay, so we have already waited 3-4 minutes for everyone to join in. Whoever is joined in, so let's not waste everyone's time now. Let's start with something that we are going to do today. And those are predominantly going to be the ratios that we are going to look at. Now, as far as we can understand, we have already looked at something that was already we know of, right? So let me share my screen. Just give me a second. Let me share my screen. So everyone can see the screen? Can I get a thumbs up or something like that so that I know that we are in the right direction? Screen is visible to everyone? That we are at a browser screen right now? Anybody who can confirm? So I'll take it as a yes if nobody is doing that. So I understand that everyone is able to see the screen now. Okay, I can see one thumbs up. Thank you so much for that part. So what we'll do is we'll start off with this right now. So now let's go to the same thing, the same platform that we have been using for Indian stocks. So we'll start here. Now we are trying to look at the ratios. Let's look at the companies which we were looking at the last. That was Vari Energies. Now everyone understood its basic, all kind of financial statements, everything we know of, everything we are aware of, right? So this is something which we can see at an industrial level. What are the industries that it is a part of, what kind of sectors it is a part of, so that we can know what exactly is happening with this company. Now these are different criterias on which it is being basically compared. Now, if I'll have to do the edit columns again, it will ask me to log into this. Not even sure that if I remember the login details, but let me just try so that I can show you. Oh, actually, login. Sorry about that. Okay, there we are. So that is what we know of so far. Now let's go to screener again. Let's search the company which we were looking at, Vari Energies. So now we have got good amount of things that we can look at, right? So what do we get out of this? Right now we are looking at your market price, your current price, your one-day return, your PE, industrial PE, debt to equity, dividend yield, and then you have got dividend payout, quarter on quarter profit, quarter on quarter sales. What I want to know about right now is that what kind of ratios you would be interested in, that you would like to see. Can somebody send all kind of ratios in the chat what you guys will be interested in to look at? Can I have some suggestions? Anybody saying anything? Price, earning, return on investment. So again, PE is already there. So that's your price to earning. Debt to equity. Okay. Let's add debt to equity. So debt to equity is already there. Industrial PE, I've already added industrial PE in that one. Anything else that you guys can think of? Debt to profit. Quite an interesting one, but not that much interesting, I would say. Um, then you have got EPS. EPS is simple. EPS remains the same. So let's try and add EPS as well. Anything else that you would like to add in this? What other things you would be looking at when you are looking at a company's analysis? What else we'll be looking at? So whatever we have right now, is it okay to look at these kind of numbers? Okay. So if nobody has any more of these, so let's carry on with these numbers. So based on these numbers, as we can see, now what we are trying to do here is we know Bari Energies is sitting at the top with the market capital of 77,000 in this particular industry. We can see that their PE ratio is 19.37 versus the industry PE ratio of 30.92. It's quite low what industry PE right now is. So which means it is at the undervalued stage if I just compare it with PE. Now PE is profit to earning, which means how much profit you'll get in your earning side of it. So if it is sitting at this level, whatever the price action goes, you are able to earn at this ratio. So against the 30.92, which means the industry is already valuing itself at 30.92. But our company, which we are looking at, is sitting only at 19.37. Does it make sense? Yes, because right now it is undervalued. Why it is undervalued, we can look into those in the later sessions, but just keep that in mind that PE versus industry PE can give you a benchmark figure that you understand where it is going to go from here on. Okay, but if you look at debt to equity, Now, debt to equity, you can see at the bottom for median for 57 companies, it's sitting at 0.33. Whereas our own company is sitting at 0.22, which means that if I look at debt to equity, which means how much proportion I'm holding in debt against the equity, I can see that it is holding something under what the industry is holding right now, which is a good sign because it is keeping its debt to equity under check. It is keeping its debt under check. So they are heavily investing or heavily taking money from the equity side of it, which means they are diluting quite a lot. Now, that can be a negative aspect as well, because if you are diluting too much, you might not be able to retain too much of the profits because that is going to be distributed among the equity shareholders that you have. So you will be giving out too much profit to different shareholders. But on the contrary, the positive side is that at least you do not have any fixed expenses such as interest payment for loans because you haven't taken quite a lot of debt. So these are both things. There are both of these things that you have to be very careful and considering while looking at any of the companies and how they are standing against the industry. Now, if I'll talk about Premier Energies from the same screen, can somebody try and take a guess what is happening with debt to equity in Premier Energies? If somebody can tell me about this. Yes, Parth, we'll come to that, how they are diluting. So basically diluting in sense that they are taking equity more as compared to the debt. If I'll compare it with your median of 0.33 versus 0.22, which means they have taken less number of debt as compared to your median of 0.33. Which means it is a good sign that their debt to equity is lower than the median of the industry itself. Now, can somebody come to Premier Energies and tell me what do you understand by looking at debt to equity of Premier Energies versus the industry? That is 0.33. Can somebody take a guess? Very high. Okay. Anyone else? Anyone else with something different what Nikita has said? Okay. It is overpriced. Actually, debt to equity never tells you about overpricing or underpricing. Let me clear that. Hype of price, no, again, debt to equity is not related to price. That was price to earning where you are actually looking at the price action. Yes, so Nikita is right there, which means they have got a high debt burden as compared to the industry itself. That is why we are looking at 0.86 versus 0.33, which is almost the triple of what the industry is sitting at. Now, before start to invest in this kind of company, the first thing that you want to answer is whether this kind of debt that they have taken, are they able to sustain or do they have enough amount of money coming in to basically keep on paying for these kind of debts? So that is one thing that you'll definitely look into. Yesterday, we were looking at financial statements when we were trying to find out what can be the problem and what is the good thing. We saw everything in financial statement. But now we are going a step beyond. We are looking at ratios because ratios, we can compare it with the other company. We can compare it at the industry level. That is why when we looked at debt to equity, we can see that median is for the industry is 33.33 versus your Premier Energies is sitting at 0.86, almost triple. But your Vari Energies, which we are trying to decode, is sitting at 0.22, which is better. So if you look at just these three numbers, you know where your company is sitting at, and you would start building your confirmation or your comfortness with the company that you are trying to invest in terms of analyzing. Okay, now we'll move on to the dividend yield. Now, dividend yield is something which is important for customers or for investors who are basically looking forward to get something more from a stock. Because let's say if I'm talking about MV, MTAR, Diamond, Fujiyama, none of them has dividend yield, which means they are not at all giving dividend for these shares if you own them. So there is no additional advantage for you guys to have. But whereas if I'll talk at Premier now, Premier is better than Vari Energies, because Premier dividend yield is 0.1% as compared to 0.07% of Vari Energies. This is not a big difference, but we'll go to the different company when we can see that there are big differences in this one as well. But overall, you can see that 0.07 versus 0.1, 0.1 is anyways better, because that is how they much giving it out. Now, dividend payout, again, one more step on in understanding the dividend yield part of it. It's not too important right now, because if you are going to look at dividends, which means you are long-term investors for at least next 5 to 10 years. So you have to understand your psychology, your risk, and then move on to the different ratios, what we are looking at. Okay. Now, your earning per share is 132, 294, whereas your industry is 13.46. Anything above 13.46 is good. But if I look at Vari Energies is almost 10 times of what this is. But if I look at Apar Industries, it is even higher. It is going 20 times of what your industry is sitting at. So these numbers basically tells us that even if we are looking at Vari Energies, we are in the right direction by looking at the industry performance. That's how you compare different ratios, different companies at an industry level, sorry, or against each other. If you are doing the comparison against each other, you can see that there are different companies who are not doing good at all. So which is Diamond Power, even though they have got a market cap of 20,000, but are they still giving you the actual return? You can see that it is highly overpriced, sitting at 141 by just looking at PE. I'm not talking about anything else right now. It's just the PE that I'm talking about. Its PE is 141. So its price is basically reflecting the movement which has already happened based on the earnings that they have, which is very high for this company. Okay, so that is why even though their EPS is very low, they have shown a very overpriced marker here. So it is kind of a company which you should be very careful about before starting to invest in this. Okay, so Parth has a question of how EPS is calculated, and I'm not able to understand EPS properly. So to make your life easy, let me just quickly open this for you so you can see it directly right now. So it's your net income minus preferred dividend divided by weighted average common shares outstanding. Now what happens is net income. Let's put it as net income as your profit of the company. Forget about your preferred dividends. I'm not worried about preferred dividends right now. You know your net income. Your net income is your profit versus your weighted average common shares outstanding, which means the number of shares that are still floating in the market, which people can buy, sell, trade in, whatever they want to do. Let's say your net income is 10,000 rupees and you have got 1,000 shares in the market, which means per share, a person is earning 10 rupees. That is fairly clear. Now, if you look at here, now let's look at this. So for Diamond Power, right now, EPS is only 2.8 rupees per share, which means your profit, your earning is only 2.8 rupees per share. But your price is almost 141 times of your earnings. I hope I am clear in this when I say that your EPS is your actual position. PE is your price action against your actual position. So that is why it is overpriced, because you're only earning 2.8, but your price is getting sold for 141 times of it. So these two things always go hand in hand. To make make it a little bit more clear, let me show you the PE formula as well so that you know. So it is price per share divided by earning per share, which we have recently seen your earning per share. If you'll divide 349 by 2.8, you can see that it will come around at 141.36, which means that you don't have the earning, but your price is reflecting something very different, which is way higher than your earning. That is why when I say if your PE is quite high, you need to look at your industry and understand whether it is overpriced or underpriced. Very important thing to look at. Now we talk about current ratio. Current ratio is something which is very common, which you might have already heard about. But this is something that I would be actually keen in knowing, that what the company's current standing is in terms of its assets and its liabilities, which are used for almost your day-to-day working, like small-term working, like 1 to 2 months kind of working. Now, I can see the current ratio of the industry is 1.77, whereas Vari Energies has 1.38. A little bit less performing as compared to the industry standards, but I still feel that it is okay based on the experience that I have, based on the numbers that I have seen. It feels okay currently. So I do not have too much red flag against this ratio right now. So I'll be comfortable in looking at this company after combining it with the financial statements that I've analyzed yesterday. So once I've analyzed the company's financial statements, there was nothing too much against it. I know that there was one number that was going down, even though overall numbers are going up. So I was fine with everything here, except for one part, that their investments raised completely fine. Also, their fixed assets gone up, but their borrowings have gone double. So that is one thing I have problem with. I read through the annual reports. I feel like that I'm fine, that they're taking the step in the right direction. Now I am ready to look at much more in depth, and that is why I jumped to the ratios. And these ratios will tell me what this company standard holds against every other company that there is in the industry. I've looked at the competitors, the major competitors. I've looked at the industry median. I know that they are almost better than every other company that we can see right now. I hope I am clear with this thing. Now, once we have done, Screener gives you one more option, and that one more option is this. Let's say I want to consider electrical equipment as a whole industry. Now, I've got everything here. I've got all 125 companies in electrical equipment companies, against which I can actually compare my different particular one company against the whole 125 companies. I've got the same different ratios at the top, and now I can compare them at a different level with every single one of them. So if I have to do the same thing right now, I can see that my dividend yield has changed substantially against Vari Energies, because Vari Energies is giving only 0.08 as the dividend yield. But I can see within the same industry, I've got higher 0.1, 0.51 as well, which makes a lot of difference. Anyone who is looking forward to invest for, let's say, 10, 15 years, this can make a lot of difference, because 0.5 after a while can compound exponentially versus against 0.08. So these kind of differences can make a lot of difference when you are trying to invest in a long term. Like you can see there is 1.01 as the dividend yield. So you can look through with a multiple set of companies in one go and try to understand and compare like what exactly is happening within this time. So that is very important for you to know, that there are different aspects in the company and in the industry which you can look at. So we looked at electrical equipment. Let us go to another broader concept, that is capital goods. Now in capital goods, there are 862 companies. We can compare it with n number of companies, whichever company we think is doing good right now. So let's say Hindustan Aeronauticals. It is sitting at 3,31,000 crores worth of market capital. Our company is sitting right here. But as you can see that our company's industry is very much different than what we are expected to look. So our PE ratio, industry PE ratio for Vari Energies is 31.48, whereas Hindustan Aeronauticals has an industry PE of 67. Now understand one more point, 36 versus 67. Hindustan Aeronauticals, considering just one PE ratio right now, is telling me that it is undervalued. And the same thing happens with Vari Energies. Both are undervalued. Now, but we'll compare both of the PEs for these companies, 36 versus 19. Even in a broader sense, they come under the same industry. But can you see the difference? The PE is 36 versus the PE of 19, which means that against these two, Vari Energies is underpriced, not overpriced, which means Hindustan Aeronauticals is overpriced. But if we look at the industry PE, which shows that Hindustan Aeronautical is actually again underpriced. I hope I am clear with this. Now let me show you one example which people get a lot confused with. Now let's just say that BHEL, so BHEL, is at this stage trading at 411, right? Can somebody look its PE against its industry PE and tell me whether it is overpriced or underpriced? Can somebody tell me it is overpriced or underpriced? Over. Everyone is clear why this is overpriced, right? But can somebody look at Hindustan Aeronauticals again? Its current market price is 4920, which is more than 10 times of what BHEL is trading for. Can somebody tell me now Hindustan Aeronauticals, it is overpriced or underpriced? Underpriced, but it is selling at 10 times more than what BHEL is selling for. So 411 versus 4,920. There is a big difference. Why do you think that difference is there? Why do you think that this is still underpriced and that is still overpriced, even selling for 411? I am 100% sure that many of you might have heard from somebody saying that share is selling for 5,000 rupees and it is still underpriced. Or you might have heard somebody saying it is selling for 200 rupees and still overpriced. Because everything comes from behind, that is the ratios. Market cap doesn't make much of the difference. Why I'm saying, Kushal, this? Because if you look at, let's just say, another company right now, let's look at Ashok Leyland. But again, the market price is quite low for this. Yes, we are talking about Vari Energies. Let's take Vari Energies right now. Market capital is less, but the share price itself is 2,660 compared to 411 and still underpriced. So the point that you make, market capital doesn't define that. It is outstanding shares that can play a little bit role into this in understanding and what are the market sentiments right now. Okay, so let's be clear on this. So everyone is on the same page now. It doesn't matter what is the share price of the company is. You can see Hitachi is selling for 31,900 rupees, even though it is highly expensive as compared to, like, if you look at the PE itself. But if we talk about and compare with Hindustan Aeronauticals, the price is way lower. Doesn't matter. Your current market price doesn't tell you whether it is overpriced or underpriced based on just looking at the price of a share. If it is selling for 10 rupees, it still can be overpriced. If it is selling for 10,000 rupees, it still can be underpriced. So never be fooled by the price itself. Look at much more in depth before you come up with that conclusion. And that one depth is given by the ratios itself. Okay, now we have looked at the PE. versus the industry, right? Let me give you thought of another thought that you can actually start looking into is how the company is doing against its own standards. Okay. Now, when I say against its own standards, what I mean by that is let's change this graph to PE ratios. Now I can see this is the PE ratio graph look like in the last 5 years for Vari Energies. Even though it got listed in 2024, so it's from November 2024 till July 2026. But can somebody try and take a guess and tell me by looking at this chart that whether it is overpriced or underpriced by just looking at this simple chart right now based on the PE ratio of its own? Does somebody wants to take a guess? Anyone having any thoughts on this? No thoughts? Nobody wants to take a guess? Come on, there is no right and wrong if somebody wants to try. Okay, under. So it's underpriced according to Kushal. Anyone else? I guess under. I don't think so. We can take a guess by this, but give it a shot, Parth. Why not? Okay, Vanshika is for under. Anything else that we have to? Anyone for over? I don't think so. Anyone will be over. So let's try to understand this chart. Now, can you see that line in the middle, the dotted line? That dotted line is basically telling you that what is the median PE for this particular chart? That is 37.6. Now, that 37.6, it actually started from 57.7, it went up till 64.2, and its median is somewhere around 37.2, but right now it is trading at 19. Don't you think that according to its own standards it has actually gone down? It was holding 57 and now it is even under its own median line. Makes sense, right? We have understood that it is low against its own industry, like cheaper or underpriced. It is also underpriced right now against its own standards. So, which means that by two standard, it has been undervalued right now. So, we understood first that their financial statements are all fine. We have no problem with that. We understood that ratios are also aligning better than what the competitors are offering versus the industry itself. Now, we even know that its own ratios are holding steady or are better in terms of telling us that they are underpriced right now with their own standards. Now, it's too easy to say that it is a good deal. Let's jump into that. No, it's still not a good deal because we have got lots of check boxes to tick. But if we'll understand by just looking at these, some of the numbers, let's just say I want to look at price to book. So price to book value is another thing which you generally are looking into when you are trying to buy a share or invest into a share, which means what is the book value of the company versus the price that the company is getting sold for. Now you can see again the median was 8, but right now it is at 5.3, which another factor, which is another instrument which shows us that it is still underpriced. If it is so much underpriced, then what is the problem? There must be some kind of problem which you should be answering before you start investing in this kind of business. But again, later stages question. Till this point, whatever we have understood so far in accordance with whatever we have learned about financial statements and now the ratios itself, how we can compare it against the competitors, against the industry, and against its own standards. Is everyone clear on this? Give me a thumbs up or a yes in the chat, please. Okay, I've got a one yes. Thumbs up. Okay. Any more things? Any more yeses? Okay. So I'll take that as a overall group yes right now, that everyone is clear what we are looking at. Now, I want you to give me another company which we can look at together right now, so that we can understand by looking at one more example, so that you guys are aware how to look at. And we'll try to do it in very little time, and you guys can get used to that. MTAR, it's from the same sector. Actually, I don't want to pick the same sector because the industry levels or industry standards would remain the same. So I would like to pick something else. Give me something out of this zone. Anything apart from the energy sector altogether? Copper, anything else? We are looking at very specific companies. Look for the companies which actually, okay. Is everyone comfortable with if we look at banking sector right now? Okay, banking sector it is. Let's pick one company right now in banking sector, and let's pick the giant. So HDFC. Okay, so HDFC, we'll pick HDFC right now. And quickly, let's have a look at its financial statements first. So revenue is on growth basis. It has been stagnant for quite a few of the quarters, which we can see. Then you have got negative financing profit. Then you have got other incomes, which makes the company positive. Overall, at the positive level, it has been stagnant for last 4 quarters, not giving too much growth. But let's have a look at the annual statement. So annual, it is again growing quite substantially. So that is what I'm interested in. Quarterly, it's fine. It's distributed. Again, I can see that it was profitable, but it became negative in financing profit. Why did that happen? I need to know. That is one thing I look into. Then again, you can see that their other income is also increasing quite substantially. What kind of other income there is, it doesn't tell me that, so I have to look at the annual statements. But one thing to look at. Then quickly, let's have a look at the net profit, constantly growing in the right direction. So that's a positive thing for us, which we can definitely look into later, like where the other incomes are coming from to understand it better. Their reserves are constantly rising, so they are saving up money. Borrowings, their borrowings have come down, so they are repaying all of that, but their other liabilities have gone up. What kind of other liabilities do they have? So they have got, again, I have to check the annual statement. One question I would like to answer before investing into this. Let's quickly have a look at their investments. Very high investments and growing at an exponential rate. I'm very happy with that. They've got some good other assets as well, in which they are increasing their cash values. So another good sign that they are holding good cash in their hands. If I'll quickly look at their cash from operating activities, they are positive from operating activities since 2023, so that's a good sign. They are also getting income from fixed assets. So there we go in terms of their investing. So that's a good sign. Cash from financing activities, are they giving it somewhere? So that's the thing. We can see that they have been repaying their loans quite a lot. So that's a plus sign. Overall, it's a good picture in terms of financial statement. So it took me hardly 5 minutes while even talking with you guys, letting you know what I'm looking at. So it took me 5 minutes to just go through with this. Now let's quickly move on to the ratios that we are interested in. We know there is HDFC. We know that there are other banking uh, organizations as well. Now let's have a look at 14.33 against industry PE of 14.14, which means that it is actually at par with the industry right now. If I'll talk about ICICI, it is a bit expensive. If I'll talk about Kotak Mahindra, it is still expensive. But the same point I was making, I'll reiterate it again. So you can see 737 for HDFC Bank, Kotak for 394. But the PE is 14.33 versus 19.67. Even though price of Kotak Mahindra, the individual share price is less, but it is still expensive than individual share price of 737 for HDFC Bank. So be careful about it when you hear this kind of things, that it is expensive just because it is selling for 1,000 rupees against the company which is selling for 200 rupees. No, it doesn't work like that. So always bear that in mind. Now we can see that HDFC right now is currently at a right price for its own standards, for its industry standards. So I'm comfortable with it. I will look forward, or I will keep this in mind that, okay, HDFC is one company which I can invest in. Now, let's have a look at debt to equity, high debt to equity, but look at the industry. Because in Vari Energies, the debt to equity was only 0.22, which is very less. So now let's say you compare Vari Energies with HDFC Bank. Are they going to align? No. That is why when we talked about it first, we talked about that we need to know who the competitors are, which industry your company relies in. That is very much important to know that what exactly is going to happen when you are going to compare. It should be exactly with the same company that you are going to invest in, not something willy-nilly that you picked up. You're like, Vari Energies was having debt to equity of 0.22 versus HDFC is giving 6.21, which is not right. No, actually both are right, because they are sitting in different organizations. They are different organizations sitting in different industries, different sectors. Let's talk about industrial companies. They have got even much higher debt to equity than this. If you look at Airtel will be having high debt to equity as compared to this. Okay, so you need to understand the market itself. But if you'll see HDFC's dividend yield, it is at 1.76 versus Vari Energies was only giving you 0.08. Again, lot of difference. So different industries have different benchmarks. So you can see that the average, the median is 0.75 for the whole industry. And HDFC is paying me better. Dividend payout, another. So if I look at EPS, its EPS is 51 as compared to 19.71 for the median of different companies for the industry itself, which means that it is in a very better position in terms of earning per share for their shareholders. I would be definitely interested in this. Again, as coming to the current ratios, everyone might have heard that the best current ratio, the ideal current ratio is 2:1. I am 100% sure that you guys must have heard from somewhere in your accounting class or some kind of videos that you might have seen on YouTube and everything. But if you'll see, the industry itself is holding 3:1 ratio as compared to 2:1 ratio for HDFC Bank, which means the company, the industry is doing better as compared to HDFC Bank. So it is a little bit of letdown, but again, 2:1 is fair enough. It is not a problematic situation to be in. So I'm comfortable with this kind of current ratio. Actually, I think I've got a question or something. Let me just have a look. Sir, we compare PE with industry PE, but industry PE made on which basis? So industry PE talks about every company which is in that particular industry. So right now, Screener itself is telling you that this is the median of 20 companies in your private sector banks at this stage. So that's how the industry PE is calculated. You can combine all of the companies to figure out what the industry PE should look like. Okay, so that's one thing. Now we know that HDFC is stacking good against its competitors, but I have one problem, that it is still fairly priced. If I've got excess amount of money which I want to invest, or a little bit amount of money that I want to invest against my portfolio, I would take a position now, but I would still refrain myself going beyond a certain amount. But if you look at, because this is not yet over, because we haven't compared this against its own standards. Now let's see. Its median PE is 19.8. And right now it is trading at 14.6. It's cheaper against its own price. So why not? And you can see the background image, the background chart that you can see is the EPS. And its EPS is constantly rising for last 5 years, if you can see that. Let's see at 10-year level, what happened at 10-year level. Again, you can see that it used to hold quite a lot of high PE and what it is holding right now. Versus its EPS are also rising substantially over the year, over the quarter, however you want to call it, but they are doing fine. Now let's have a look at price to book. The same story goes. I can see that there is a cycle going on in the charts behind, so which is something very different. But if I'll compare it with at a 5-year level, you can see it's still cheaper at 5 year, it's still cheaper at 10 years. Let's see what they are doing in 3 years, again cheaper. So against its own standards, this is turning out to be a cheaper share right now. Now, how many of you, after looking at these kind of numbers, these kind of financial statements, and whatever we have done so far, are comfortable in investing in HDFC Bank? Okay, you are interested in HDFC. Anyone else? I think it's good. Okay. Anyone else? So Dave is interested in RBL. Okay, I've got quite a few saying that whatever you guys have seen so far, that it looks like a good deal, right? So we are not wrong in saying that it's a good deal. It is getting beaten up by the market right now, because let me show you how it is getting beaten up. You can see that what happened to this company in last 5 years. So it started somewhere here at 763. If you would have invested 5 years before at 763, you are still at a same price range at 734. Now what's happening? What is wrong? These are the kind of questions you should be answering before getting a position in this kind of company, because they touch 1,000 rupees here. I've got somebody saying something. Let's have a look. That changed the whole game. Okay, so what changed the whole game for you, Parth? If you can tell it for everyone. So Parth, can you tell everyone what changed the whole game? I think it is lower than its opening price. So just, okay, a guess. Okay, let's have a look at their maximum. Their opening price was 27 back in 2026. Why do you think that at a 3-year level, it is still at the same pricing? At a 5-year level, it is still at the same pricing. Can somebody try to take a guess? That's fine, but somebody can take a guess why its pricing it is still at the same level after 3 years and after 5 years. Anyone wants to take a guess? Nobody wants to take a guess? Okay, I've got one person saying something. Management issue. Not exactly. It just gave a little bit of correction, but not exactly because of that. Due to its sales, no. Anyone else? Well, they faced a lot of problems in terms of, I guess everyone is aware of Warren Buffett, right? So Warren Buffett also said that there are companies which will give you everything. It's just that these companies right now, the HDFC, if I'll talk about, there is nothing that I can think of is wrong at a fundamental level with HDFC. Yes, they were in news for a couple of times very recently, so they are facing that kind of an issue, but it was never an issue. They already solved everything. The only thing is that this company has been moving sideways for last 3 to 5 years. But whoever is owning that share before that 3 to 5 years are still making good amount of money. That is why I said trading is not the answer. It's investment that you should be interested in. And in all fairness, whatever you have invested for, let's say you have invested in this company 3 years back, let's say 5 years back, it was at the same price. You did not get your price increase. But HDFC is one company which has been paying you dividends for last 5 years, I guess twice or thrice every year. So you are actually getting money in your hand by not doing anything. So that is the way of getting you onto their stocks and try to invest in it more, even though price action is less. But still, you are getting a regular income just by sitting and doing nothing. So you have to understand again, I would roll back to the same thing again, which I said in the last two sessions, that your psychology will define why and how and which share do you want to buy. It will completely change the game for you, for me, for anyone else. There are, I guess, 20, 25 or 30 participants in this session right now. All of them will have different set of ideologies. Some of you still think that HDFC is a good proposition, and some might be doubting right now because that they haven't grown from last 3 to 5 years from where they were sitting. But you also have to understand within this last 3 years, there has been a stock split for HDFC. So the share prices has been adjusted according to that. So there are multiple factors which goes behind when you are looking these numbers. But overall, in terms of ratios, we have gone through multiple ratios today. We have tried to understand how we can compare. I haven't gone into the formulas of the ratio. Why? Because formulas, you can find it on internet. There is no rocket science to it. It's just there is one formula, but how you read that formula, or how you read, or how do you take it against different industry standards or own standards, that is what will make a lot of difference. Yes, Kushal. So ROIC is another set of formula which you can use. That is again return on invested capital. You can use it on exactly similar terms. Let me add ROIC in this so that I can quickly show you what I mean. So ROIC, there you go. So that's save column, and you can see that there is ROIC for HDFC Bank. It is sitting at 7%, and it is industry standard. It's 6.4. So it's almost similar as industry standards. There is not much of the difference in this case. 3-4 years, HDFC split it and increased their number of shares. So price is like that. Is it annually? All of these numbers, what we have put there, are annually. So their price have basically, I'm not sure how the screener portrays this, but whenever there is a split shares, let's say your shares are getting split 1:2, and you are trading your shares at 100 rupees. So if there is a split at 1:2, your share price will become 50 rupees. And from 50 rupees, it can still go back to 100. And then the price that you are holding will also go 100% from there. So that's how the split share works. It's not necessarily that it is sitting at 730 to 730. It might have gone from 730 to 350 and come back again at 750. So which means you are already making double. So there are different parameters to it, which you can look into before start investing. But that is just one aspect. Again, I would roll back to the same thing. I haven't gone through with the formulas, because formulas, you can find it everywhere. You can calculate it by using Excel, by internet. You can find everything everywhere. It's just how to compare them. What these formula actually is portraying is important. I will focus still on the same thing. Now we have got last 5 minutes left. I'll quickly ask you that if there are any questions, can somebody put in there, or can I get a thumbs up saying that everything is okay? Any more thing that we can look at? Because we have also covered two companies today, which is a win-win for us. And any more questions, anything? So Parth, it is good. I wouldn't say it is very good, because if you'll see that your ROIC is 7.02 against 6.4, it is not that high. It is almost on the similar grounds that the industry is following. So you have to take everything in account at a broader level, not just by looking at one single formula. Because I can see that PE versus industry PE is almost similar, which means it is fairly priced, which means their ROIC is also fairly aligning with the market itself, the industry itself. So it is a perspective call that how you want to look at it. For me, it is fairly priced. For me, I can still wait for the correction to happen. I would be taking position then. For some of you, you might feel like, it's fairly priced and I'm comfortable taking at least half of my position right now. So we have got different mindset. And sir, what are important ratios to be studied properly for analysis? That one question I would leave with all of you, because anyways, I was going to say the same thing and you have just jumped ahead. So find out the ratios, at least try to find out 4 ratios which you are comfortable in using while doing the analysis. Because I am comfortable personally myself with PE, with profit, with price to book. Second, third one is important for me is I generally look at debt to equity and a little bit of dividend yield. And apart from that, I would consider myself using this one, that is market cap to sales. So this is price to sales in other terms. So these are 4 to 5 which I personally use and I am comfortable in personally using. As you guys mentioned, ROIC, ROE, and EPS and everything, I personally don't use them. So that is my personal take. Again, you have to figure your own ratios out. For me, that set of ratios works fine. Any other questions? Can I get a quick thumbs up that we are all good? Okay, I've got thumbs up. Sir, material, again, it's everything is listed on the website itself. So we talked about this last time as well. So if you'll go to the website, there is a tab as events, and in that events, follow this particular course and you can see all kind of material, whatever there is. AI option there. Kushal, can you explain a little bit what do you mean by AI option? So it's Taxila.in. Kushal, can you tell me AI option? What AI option are we talking about? Above alert, there is an option of AI. Are we talking about the same website? We actually used AI chat GPT beforehand. Like we used in last session, right? I have never used Screener AI, quite frankly, and I'm not too sure how it's going to work. So let me ask a quick question. Evaluate HDFC and tell me whether it is overpriced or underpriced. See, that's why I told you. So it is paid. So I haven't used this and I haven't used AI screener, like screeners AI for a very, like ever. I generally use Chat GPT. I know what kind of things I'm looking at. So I'm comfortable using Chat GPT instead of using screeners AI. I am much more comfortable in using Webull AI. So I'll give you the name. So it's Webull. That is the trading platform generally I use for all of my US portfolio. and their AI is pretty decent enough, and I enjoy using that. Okay, so can I get a quick thumbs up that we are okay and good to go from here? It's already 6 o'clock. Anyone can give me a quick thumbs up? Okay, no problem. Thank you so much for that part. So, multi-bag AI, again, personal preferences. Whoever is using what, that is completely fine till the time you understand what kind of things you are looking at. So that is my main motive. That is why we are having these kind of conversation and not just looking at the platforms which you can actually see it on any YouTube video, and which I'm not very much concerned about. So that's fine. So I'll leave you guys for today, and I'll see you all in tomorrow's session.